morning. My name's Bianca Silva and welcome to our second workshop of the 2022 series. This morning we're doing a slightly different format for the webinar because we have collated a few sort of topical issues or things that we think you should be aware of, or things that we know we have lots of questions about during the course of the year. So we thought we would cover these and obviously welcome you to pose any questions that you might have, either as we go through or at the end of the webinar. So if we get particular questions on the subject I've just talked through, then we will probably just stop at that point and cover off some of those questions. So the areas that I'm going to cover is just an update about the changes in how you account for rates. And those of you that attended last week will have heard of this. Also a reminder about land and building valuations, because this can be a tricky area, and it's just to make sure that should you need to have something ready for the 31st of August 22, that you've got that in hand. And also depreciation is linked to that. A brief couple of slides on the chart of accounts and the ESFA programme for automation. Some of you may be involved in the next one, which is subcontractor certification, because there's changes about what is required from this year onwards. So we'll go through those changes. One area that we get lots of questions about is about reserves, what to say in the reserves policy. And it is an area that, to be honest, is not terribly well done. So, we'll try and give you some pointers on how to improve what you put in the Trustees Report. Lots and lots of questions always arise on leases, whether they're operating leases or finance leases. So we go through the main principles on that. And then a section on related party transactions. And then obviously general sort of questions and answers. So the first slide is about rates, and I expect most of you have picked up from the Academies Accounts Direction that from April 2022, there are some local authorities who have opted into a new scheme with the ESFA, whereby the academies will not receive a rates invoice. The local authority submit it to the ESFA to be paid. So what you need to do is check whether your local authority has opted in or not. We've looked to see if we can find anything anywhere on websites detailing which authorities have opted in and which ones haven't, but we haven't found anything so far. So just take a little bit of care to make sure that you haven't paid promptly at the beginning of April and sent the invoice to the ESA to be recovered, not knowing that your local authority has sent the bill to the ESFA to be paid as well. So just make sure there's no double counting that's going to go on. Because you are still responsible for your rates in the accounts, you need to show the rates cost, which will be sort of effectively debiting rates and crediting the GAG income, because at some point the ESFA will have deducted the rates recovery from the amount of GAG that you receive. So I suppose there's going to be issues on when has the ESFA done that. Have they done it in the April, May, June, July, August GAG instalment or not? Because you may then, if they haven't, you may need to show a possible accrual for the rates for August 2022 and a debtor for the same amount, knowing that the ESFA are going to give you that refund at some point, but they haven't done it by the end of August 22. So it's just something to watch out for, and also for next year, billing authorities that didn't opt in this year may opt in next year. So just keep an eye on that. The next section is about land and building valuations, and it's linked to the comments, really, that the reason why we put this on, we thought we'd talk about this morning, is because the SFA look at academy accounts and look at the audit report qualifications, regularity qualifications in audited accounts at the end of each year. And certainly accounting for land and buildings has been a common area leading to qualified accounts. And we've just put up the statistics from 2020, you know, we haven't got the one for 21. But it is something that does occur quite regularly as a reason for a set of accounts being qualified. And it is normally because land and buildings is a significant figure in the accounts, it's a material figure, and where academies haven't been able to get a valuation or left it too late to think about valuations before the accounts are signed off, because there is a figure that should be a material figure that is missing from the accounts, that could lead to a qualification in the audit report. So the idea of this morning's few slides is to ensure that if this is something that's going to affect you in August 22, that you've got time to think about it and plan for it. So the key thing to remember is that if you were, you know, a lot of schools think about using the DFE valuation, because we know that the DFE do their own valuation for their own purposes to produce accounts for government on the academy sector. We know they carry out that valuation each year when they do the request to you in November to provide information about your buildings and the age of them and the state of them and so on. But obviously they carry out that valuation, ask you for the information in November each year. So obviously that's far too late to receive anything back from them before the accounts are signed off in December. So therefore you do need to think about what else you can get instead of waiting for that DFE valuation. And most of the qualifications in audit reports are because schools thought they would wait and bring the figure in the following year. So obviously they're missing a big figure for that particular year end, which is why there would have been a qualification. So you need to think about when this might apply to you. So if there are new schools going into a MAT, there needs to be a value of the land and buildings that those new schools are bringing with them. Or if you've got assets that are being constructed, when that construction is complete, you need the value either from the contractor or from the DFE or from the local authority, whoever is doing that construction. They need to provide those costs to you. So it's something to plan for and make sure, particularly with the contractor, the DFE, the local authority, that they are ready to give you that information, that you have discussions with them early on to make sure that they realise they've got to give you something, and it may be they've got to give you more than just a single figure. They might need to give you a bit of a breakdown, and I'll cover that in a moment. Because as I say, if you don't get the valuation when it's needed for an August year end, then you are going, it is a material misstatement of your accounts. So there was also a reminder in the accounts direction this year about when you bring in the value of land and buildings. And I think it is, again, because they've looked back at what happened in the previous few years and for things that weren't quite accounted for correctly. So if an asset is under construction, but it's being built by the DFE and it's not yet handed over to the Academy Trust, then you don't recognise anything in your accounts yet, because it doesn't yet belong to the trust. It's not yet under your control. It's still being constructed, you know, by the DFE. Again, if it's partly, if you're funding it, the trust is funding it, but it's not yet fully complete, it is your asset, is under your control, but it would show as an asset under construction, and you wouldn't charge depreciation because you're not yet using it. And in the first scenario, when somebody else is building something for you, it's the value of that constructed building or site, whatever it is, and it will be recognised as a donation, so income in the restricted fixed asset column of the accounts, and will show as freehold or leasehold on the balance sheet, and depreciation will start from that point. So it's what you start depreciation once the building is fully complete and it's under your control, ready for use. So that's just a reminder there. So as regards the options for valuations, how can you get to the number that needs to go into your accounts? The overriding rule is that whatever the number is, it's got to be a reasonable and reliable estimate of the current value at the time that you bring it in. So obviously, it would be very easy if a school is converting into an academy, coming into a multi-academy trust, previously maintained school under the local authority. The local authority will have the details of the cost or the valuation and the current valuation. So because they have to do that, it would be the easiest if they can provide you with that valuation. And I know that can vary from local authority to local authority. Some local authorities are very willing to just, give you the information from their records. Others are not so keen. So this is why perhaps having early conversations with them, and maybe as part of the arrangements for new schools coming into a multi-academy trust, that is part of the discussions to say, if they're coming from a local authority, one of the conditions or one of the requirements is that they do give you the details of the valuation. The other option is to pay for a professional valuation, so for a qualified surveyor to carry out a valuation and provide that to you. Obviously, that does come to a cost to the trust. Again, costs can vary, whether it's £2,000 plus, I don't know now, but that will be a cost. Yes, you can use the DFE valuation, but that's likely to be at the wrong time, and therefore you won't have it in time for the sign-off of accounts. I'm aware from the ESFA Auditor Forum that they have got no plans to change the timing of when they carry out those valuations. It is something that is asked about a lot, so perhaps in the future they will change their timing. We can inform you of that when we know. The other option, which some schools have done, it's probably quite rare, but they've carried out their own valuation by looking at similar sites in their local area. You're looking at the age of the buildings and so on. But obviously, the trustees have got to be quite confident then that they've got the skills to do this, or the person within the trust they've asked to do this has got the skills to carry out such a valuation. And if this is something that you do, you've got to be aware that we as auditors, or any auditor, will ask for your detailed calculations, your thought processes, the evidence of the number that you've come up with. So, that is quite a challenge, because if you're, potentially going to say, well, this building is worth 12 million, why is it 12 million and not 10 million or 15 million? You've got to have a very good working paper evidence supporting calculations of how you've got to that. The other option that is sometimes used, and again, this is a reason why sometimes there is a qualification on an audit opinion, is because the school has used the insurance value. And that is not the correct value, because it's usually on the basis of a rebuild cost, which is not the value. That's not the same as the current value of a building. So just so you're aware of the different valuations that you could use, and the pros and cons of doing that. In terms of how you account for the evaluation, I've given you the reference in the Academies accounts direction. And within the accounts, you've got to have an accounting policy for how you've accounted for land and buildings, the basis of the valuation, so to just describe which basis you've used. So that's referring back to the previous slide there. And then what is your depreciation policy on the land and buildings? So land is generally not depreciated because that's obviously has an infinite value. Buildings do need to be depreciated once they're operational, and you need to consider the useful economic life. And that can vary, because some buildings do last a really, really long time, and a very common policy is 50 years. But if but you do need to stand back and think, well, actually, if your building was done in the 1980s, and maybe not using the best material, you know, we're already 40 years in. So should you be depreciating at something less than 50 years because, you know, it will need structural, you know, a large structural revamp, you know, in a period much shorter than 50 years. So I think, you know, it's refining policies and refining the components of the valuation, which is why I mentioned earlier that when you get a valuation, it's to know what's included within it, and is it possible to break down the total number between different elements. And in accounting terms, that's called components, because different components could be different buildings with different ages, which then may be in different states of repair and therefore may need different depreciation rates. But also within your buildings, the components that may be larger values will be things like boilers, the roof and lifts, and they will more than likely have a different lifespan than the building as a whole. So I think it is to think about refining depreciation policies to different elements within the total buildings valuation that you have. If you have church schools, there it's going to be different treatment, and within the Academies accounts direction there is lots and lots of guidance for church schools and how to value their land and buildings, because usually church schools are occupied under a license from the diocese. They don't have 125-year leases. The freehold is normally owned by the diocese or a religious organisation. No rent is usually payable. They have a supplemental agreement specifically to do with the property, and there is usually a notice period of 2 years. So therefore, it is unlikely, you know, I should think 98% of the time it is unlikely to recognise then the land and buildings as an asset, mainly because the resource is controlled by a different entity, you know, controlled by the diocese or the religious organisation. And the trust, the Academy Trust, might have delegated management authority, but not necessarily control. So therefore, that is the usual reason for not recognising the land and buildings on your balance sheet. So that is why, you know, church schools, you know, are treated differently from the main bulk of local authority schools. So just for those of you that do have church schools or within a map, that you are aware of that. So the next section that I will cover you very briefly is the chart of accounts. So for the last few years, the DFE have been working with financial management system suppliers to try and develop something that aids automation of producing accounts and completing the AAR. The first stage was producing a standard chart of accounts. So that has been progressing over the last few years, and the number of Academy trusts that are using the ESFA standard chart of account is gradually going up. I still think it's only 20–25%, but it is moving forward. And for those of you that haven't yet done it, you have to first of all check whether your particular software supplier has adapted their system for the Academies, the SFA's standard chart of accounts. The SFA say that if you do convert to their standard, then the advantages are that you can pre-populate a lot of the information from your trial balance data into the AAR, which potentially can save time and removes sort of repetitious data entry. I put data entry, so that's a mistake there, but it's data entry. And ultimately, the more schools that use the standard chart of accounts, the better the comparison of data between schools when you look at the benchmarking data, because it means everybody is using the same analysis across the sector. So obviously we've got a way to go, because, as I say, I think it's only about 20–25% that converted so far. But if you haven't yet done it, you are thinking of doing it, it's not a quick transfer across. First of all, your own system supplier's got to have adopted the ESFA Chart of Accounts, so you need to convert to that new package. You need plenty of time to plan for it, because you've got to remap all your current codes to the new codes. And the standard Chart of Accounts produced by the ESFA have got, I think, literally thousands of codes that you can use, because they have gone into a lot of detail. So you do need to think very carefully about where your particular data needs to end up. So you need to plan for that time. And obviously, the ideal is that you do it so it's ready for the 1st of September in any one year, so that you've got a whole year's worth of data. That would be the ideal, because otherwise you will have, if you do it any other time during the course of the year, you will have probably 7 months on one system and 5 months on the new system, because, you know, running everything to 31st of March again is that if you're not going to do it for the 1st of September, then the next best time is transfer from the 1st of April, mainly because of the budgeting and forecast return and comparisons to 31st of March. So it is just being aware that you need to think about the issues and plan and the time that it will take within the finance team to do that conversion. The other point, which is the point on the bottom of the slide, is that the data needs to be complete. For you to use the AAR pre-population, you need to have your trial balance that you upload needs to have all the journals in it. So it does mean that the local government pension scheme journals need to have been done, depreciation needs to have been done, and so on. So it does mean that you've got to think about getting any audit journals or year-end journals done after the audit and before you upload a trial balance through the ESFA system to be used into the AAR. So, you know, again, plan for that. With the automation process, you need to go through a certain process in order to do this. You need to have a person that's going to be named as a person to transfer the data to the ESFA online. The ESFA see your data because you have to give them your trial balance. You need to give them the consent that you are going to be sharing that data with them. And as I mentioned a moment ago, that data needs to be complete. It's not 100% foolproof yet, in that when the button is pressed, the AAR is completed, you will be able to check or see which data is being done and is complete, and I think it's color coded or something, so it might be green to say it's done. But there will be certain areas that you do need to check, and it will identify gaps or particular areas that do need to be manually completed still. And that tends to be things that are derived from the notes to the accounts, because obviously your trial balance is the actual data you've processed, but there is specific information like, you know, average number of employees or highest paid employees or trustee remuneration and so on, that is derived from the notes to the accounts, and that may need to be manually entered. But the automated cells are identified, and you can go in, or you would need to go into the AR form still and correct each cell that as required. So I think, Karina, there was a point or some questions raised, so maybe we'll take that before I move on.
Yeah, just a question on whether it's compulsory to adopt the Chart of Accounts yet?
No, it's not yet compulsory. The ESFA are keeping track of the rate of conversion to the Chart of Accounts, but they are aware that it's still, you know, a relatively small percentage. Their ideal is that everybody will convert ultimately, but I still think we're probably a few years off that, or even mandating it. So I think there's still, you know, I can say, you know, my guess would be you've got at least 2 years before it would be anywhere close to being mandated. One interesting development this year has been that the automation now, if you use the standard chart of account, you can actually have access now to a draft financial statements workbook, whereby again your trial balance is input, and then it automatically groups things together to produce the draft financial statements. So for those of you that are on the standard chart of accounts, you might want to have a bit of a play with that to see what can be produced in terms of directly from your trial balance. Again, it won't necessarily match the final set unless you have done those journals like depreciation, local government pension scheme, and so on. And there is a guide on the website about the automation process if you're interested in looking at that. So the next topic I'm going to cover is subcontractor certificates. So this will only relate to those of you that got post-16 funding for education and training, and this is often something related to sports activity, and it's where you've received funding and you engage with a subcontractor under an agreement to help provide that education and training. So the ESFA are looking or have looked at the certification they require for the expenditure of those funds using a subcontractor, and they've looked at the data, the audit certificates that they have used in colleges for many years, and they appear to now be transferring or asking academies now to obtain the same sort of qualification or certification, sorry, not qualification, certification. So rather than a simple sort of Annex G type certification that most of you are used to, there is a different type of audit report required. In the guidance on their website, and they do have an ESFA subcontracting standard, they do refer to the audit certification being required for this year, for 21-22. Then in another place it says it will be, the requirements will be in from 22-23. So we're not quite sure whether it's going to impact relevant trusts for this year or next year, which is why we've decided we will alert you to the fact that you may be required to do it this year. And it applies to any trust that has subcontracted out up to the value or over the value of 100,000 in the year. So it may only apply to a very small number of you, but you just need to be aware of this, because the certificate is not about, have you spent 100,000, where are the subcontractor invoices that show that you have spent 100,000 plus. It is more about certifying oversight and management of public funds to the best effect to benefit the learners. So if it is for this year, then the deadline for getting that audit certificate is the 31st of July. But at the moment, we're aware that Academy trusts are not receiving email notifications from the DFE or ESFA to say an annex, whatever is required, or a certificate is required. So for those of you that do have spent more than 100,000 on subcontracting for this particular area, then you do need to look at whether the DFE might be expecting something from you. And to do that, we've put the instructions on the screen. You need to go into the ESFA document exchange and to see if subcontractor external assurance document return is available to you within a certain section, and whether it's there, because the option would only be available to trust that would be in scope for this year. So we do recommend that you check that on the document exchange to see if you are one of those. Because if you do require a audit report certificate by the 31st of July, then testing needs to be carried out of evidence in 9 areas, and we've listed out the 9 areas, and they are quite detailed because, for example, in pre-award activities, it's about showing you've got evidence of a educational business rationale, you've got procurement strategy in place, and what is the process. For the, award, contract and management, what was the oversight of the contract award, what was the provision to deliver the programme, have staff got defined roles, and they know about the issues to report anything to those charged with governance. So there's lots and lots of detail, and that is all included in the ESFA subcontracting standard that's on their website that was published last year, because for each of those 9 points, it does go into a lot of detail about what the auditor would need to look at, because it's more about your processes that you've got in place and the evidence of that, and how have you got processes to measure the benefits that have been provided through using the subcontractor, or the performance of that subcontractor contract, or the people involved in the provision have got clear defined roles and job descriptions, and there's a process over the payments, over the risk management, and that is regularly monitored, and so on. So it's a lot wider and more detailed than anybody who's had an Annex G and gone through that process there. So, as I said, the key thing is to check that if it is applicable to you. And I would then recommend that if you think you might be, because you do have other access to the certificate, that you do then contact the ESFA to just double check. They do mention in the guidance and Annex B, which is on their at the back of the guidance, which is just a very simple form, but it is the guidance behind it that gives you all the information about what an auditor would ask to see. And obviously there's going to be a cost to obtaining that certificate. What we've done on the next slide is to give you the email address for any queries about this area, because I think if you do find it appears that you do need to do this, well, I would suggest you send a query immediately to the ESFA to ask specifically about what you need to do for this year, because they do say that they're going to update their guidance and their requirements for July 21, but it's getting for July 22, but it's getting very close to that deadline of you having to arrange for the certificate to be issued, and therefore has their own timetable slipped, and are they going to really only apply it from 22-23? So I think it's a case of pursuing the ESFA and checking you get to the right person at the ESFA who can give you the exact details of what is needed, because we know that at this moment in time it's not necessarily very clear at all. But we've given you the answer that we have received so far, or what is on the website so far about it. So I hope that helps those of you that might be captured by this particular requirement. So the next area is about reserves and the reserves policy. So first of all, just a reminder or to make you aware that in the budget forecast return that has to be submitted towards the end of July this year, there is a new requirement in it, in that Academy trusts that hold reserves of more than 20% of their income, excluding donation of fixed assets or anything to do with pensions, there are some additional questions that are going to be asked. And this is from the background of the Public Accounts Committee, and I'm going to put the wrong way there, I've just realised. Public Accounts Committee have asked the DfE about the financial health of schools and whether there is a geographical variance between financial health in schools, and which, can they identify whether there are particular areas of the country where academy trusts might need more support from 2022-23 onwards. And the DFE are using the budgeting budget forecast return as a way of seeing what reserves academy trusts hold, and then asking the questions about why are you holding reserves. And on the budget forecast return, there's a drop-down menu that gives you options that you might tick or whatever to say why you might hold reserves. And the examples they give are that you've got some building projects that are going to be done in the future, or you've got non-building capital projects that you might be doing, and this might be to do with curriculum development, or you've got technology infrastructures you want to put in the future, you need money for that, for example. It talks about staff retention and development, so that might be about expanding something on training for staff, or expanding the number of staff because you're a MAT and have rapidly expanded, for example. Strategic development might cover things like increase in schools if you are a multi-academy trust, or maybe even developing into a multi-academy trust from being a single academy trust, and that's connected with the MAT growth. And then anything else about the future or uncertainty, and that might apply to where a trust has got decreasing pupil numbers, or you're working with an in-year deficit, or you can predict that there will be an in-year deficit in the future, that you will need reserves. You've got reserves now to fund that future deficit. So you've got to remember now that the DFE will have a link then between, if this does apply to you, they will have a link between what you've said in this budget forecast return of why you're holding reserves, to what you then go on to say in your trustees report for the 31st of August 22. So it is just make sure that those two elements are linked. And in the trustees report, under the reserves policy, just a reminder about what is required. You need to have a policy for holding reserves. So trustees do need a view about why the trust needs reserves and what the level it is. And this is where very few trusts actually articulate this very well. Most of you would say what you have got, not necessarily what you would like to have, what you aim to have, and what that level might be. And you are, according to the Charity Commission guidance on reserves policy, which is a good place to look if you're unsure, it does state you're supposed to say what that level is. So you've got to, the trustees have got to articulate, well, we need a minimum of, £500,000 or £2 million or whatever it may be, and why. And the reason can vary from year to year, because you might be building up for a capital project. That capital project is then done, you've used the reserves, your reserves then go down significantly, and therefore you think, well, okay, we don't need that big pot, we've used that pot, we don't need it anymore, but we need it as a safety net, as a contingency for the future, or because we've now got another reason and we want to build it up. So I think the difficulty for trustees is determining the level that is ideal, because it will depend on their own understanding of what this is about. So I do think, referencing the Charity Commission guidance on a reserves policy would perhaps be useful. You also need to state, the bit about splitting the amounts you've actually got at the year end is easy enough to do. I think you're all aware that if you've got deficit funds, you need to state in that policy section, reserves policy section, why you've got deficit funds and what you're going to do to eliminate it. And certainly the most common one is obviously the pension deficit, the LGPS pension deficit, but there's a standard explanation for that. But it's really, have you got any other deficit fund that you do need to explain? So I think the main thing is to make sure that it does match in with your, what you've stated on the budget forecast return. And I think we've had a question posed, so Karina, can I ask what that is?
Yes, certainly. So we've got an Academy Trust that is planning to spend some of their reserves next year. So they're looking at it from a budget forecast point of view. Should they show that as a planned overspend in the budget, or should they submit a balanced budget and then show the forecast overspend in the management accounts during the year?
So with the budget forecast return, what you've got to do is show what you plan to spend. And then with the, so if it is capital, that's going to come out of, be in the capital section. If it's major repairs, it'll be in the expenditure section. But you actually show the amount you've got to spend, which means that you will have, in theory, an in-year deficit. But that's the reason why you hold reserves, because in the funds note, the very detailed note that's towards the end of the notes to the accounts, you will show that that deficit, if it is funding capital, a transfer is done from the income reserves that you have to meet the cost of that capital. So that is a very valid reason why you have reserves. So it will notionally show as an in-year deficit, but there is a calculation on the budget forecast return that shows reserves and will show then that you have got the reserves to meet that expenditure that you're showing. So if I just show, well, I suppose reiterate, why you might hold reserves. And I think they're probably all the reasons that the ESFA put on the budget forecast return. So it is to fund fixed assets in the next year or the future years, to provide some working capital, because although the GAG grant is received, each month to help you meet the expenditure for that month, you might want a bit of a safety net there. To support any other future projects, and that typically tends to be IT things or major repairs to items you might not get SIF funding for. So you might want to build up your own reserves over time in case you're not successful for SIF, or you have to make contributions towards SIF projects. We've mentioned expansion of a trust, or maybe reorganisation. You're changing the way you do things, so you need some extra resources to do that, or to meet any sort of unplanned events, because we're all aware that there are some types of expenditure that are outside of your control. Obviously we're all aware now of inflation rates and the cost of electricity and gas, the increase in the general cost of things, and therefore, what level of GAG funding is going to meet that increase in expenditure that is going to hit everybody in the next few years. So it might be that you have to hold back some reserves because you know that there is going to be some increased expenditure.
Yeah, so we've had another question, Bianca, about the budget forecast return. So One Academy Trust has been advised that their energy costs will rise between 86% and 129% in 22-23. And they're asking, how should that be shown on the BFR?
So you have to, on the BFR, you calculate, you put in, your expenditure, and so when in the detailed calculations supporting the BFR data, you will put in your estimate then, i.e. showing electricity or gas as it is now, plus 129%. So you calculate that actual figure, and that's the figure that you use as expenditure in the BFR. But I think in the BFR, there is a place where you can put some of the assumptions on what you've used, or if there isn't, you should certainly have those assumptions written down that the trustees approve to say expenditure is X because you have assumed gas and electricity will go up by 129%, because and the evidence of it is that you've had notification of that.
Yeah, as part of the 3-year forecast, you can there is a box where you can put your assumptions in, and I would definitely put that in for your 22-23 numbers. Yes.
So to make sure that you anything like that is different for this year, you notify that to the ESFA in that description box, narrative box that's there. Thank you. So I think the main lesson, I suppose, or a point to carry away from this section is that, you know, trustees do need to calculate a level of reserves that is required to support the policy. And we know that that is challenging because not many of you, you know, tend to do that. And I think it is worth having, you know, trusts developing a working paper that shows this is what their thought processes were at the time of setting that policy, you know, what the assumptions were, because obviously they will change over time. You know, and what were the uncertainties that you know, things that you didn't know that you had to make an estimate of, that you've used in calculating something at this moment in time. And as I say, do look at the Charity Commission website for their guidance on how to set a reserves policy. So the next section is about operating leases versus finance leases. So I'm sure all of you are aware that the ESFA have published a good practice guide about leasing to give you guidance on making sure that you do define and know whether it's an operating lease or a finance lease. And also there's details in the Academy Trust Handbook, and I've shown the reference of 5.25 about the different types of leases. And I'm sure most of you are aware that you do need prior ESFA approval if you have got a finance lease, because that is a form of borrowing. There's also other criteria, principally to do with land and buildings. But there is discussion going on. So this is alerting you to something that isn't yet in place, but probably will be, but we don't know for definite, because there is a review of the Financial Reporting Standard 102, that's the basis of the accounts, for accounting period starting after January 2025. And the ESFA have looked at what the changes might be and have looked at the impact on academies. And one of them is implementation of IFRS 16, which is about leases. And effectively, it says that all leases will be classified as finance leases. And obviously, if they are all classified as finance leases in the future, it means that every single lease will have to go to the ESFA for approval. So the ESFA, DFE, have developed their thinking on this because they do want to reduce or not add to anybody's burden. So therefore, they are going to the Secretary of State to get consent for particular classes of leased assets that do not require prior approval. So we've given you email addresses if you do want to ask some particular questions about particular leases that you've got and treatments. But what they're going to do is that, assuming the Secretary of State does give consent, then the DFE will provide a list of assets that you will not need to get approval for. And the current drafting says all existing leases in place at 1st of April 22, and for maintained schools and for academies on the 1st of September 2022. So any leases you've got in place, that's fine. And then for new leases after 1st of September 2022, if it's for IT equipment, catering equipment, etc., you can see the list there, then assuming this authority is given, you will not have to go to the DFE for prior approval for signing a lease for any of these types of assets. But the one missing from the list is land and buildings. So, you know, that presumably there's going to be separate rules about that. But at the moment, we are not aware that this is definite yet. The DFE have not yet confirmed that this is absolutely going to be the case. So we're just giving you prior notification that this might come in, but obviously we'll watch over the summer or early autumn to see if this is put in place. Because as I mentioned in the prior slide, the change doesn't actually come in until January 2025, so this is way off, but the DFE seem to be trying to put something in place, you know, early adopting. So we will have to notify you. So until this is absolutely definitely in place, you do still need to carry on looking at your lease contracts, and before you sign a new one, determine, is it an operating lease or is it a finance lease? If it's a finance lease, you must get prior DFE approval for it, DSFE approval. And we've, on this slide here, we've said, well, what are the signs of a finance lease? What signs do you look out for? If your rentals are going to cover more or less the whole of the cost of an asset, then more than likely it's a finance lease. If it's something of a specialist nature that only you can use, it's probably going to be a finance lease because it can't be given back to the lessor and used by somebody else, and so on. So there are definite sort of characteristics of finance leases you need to look for. And certainly one of the ones that we've been very much made aware of in the last year or so is that quite a lot of operating leases, in the finer details of it, seem to have a finance lease embedded in it, particularly for catering equipment. So if you are going to be renewing catering agreements going forward, if we haven't yet got the approval, because catering equipment is on the list or current draft list at the moment, if this isn't confirmed, then anything that you sign September onwards, you still need to look at getting permission for the finance lease bits of the catering equipment that's embedded within the operating lease. So the next section is related party transactions. And in the AAD, there was a reminder that trustees must, in their Trustees Report, describe processes in place about managing conflicts of interest in the Academy Trust. And on the slide, there's a guidance to it. And this is linked to related parties as well as sort of a slightly wider area. So specifically for related parties, it is the second highest reason for a modified regularity opinion in last year's August 21 audits. And it was really because either Academy Trust hadn't got prior approval for a related party transaction greater than 20,000, or they had incurred a related party transaction but it wasn't at cost, or the conflict of interest between an issue hadn't been managed or documented sufficiently well. So it is, and that's the reason why we flagged the area, because it is an area that is not being dealt with correctly by quite a lot of academies. Because if you don't get that prior approval, then and the ESFA pick it up, they will set out this is when you've, my next bit of is about when you go onto the portal to get approval for a related party transaction. If they don't approve it, if they say no, you can't do it, then you do need to share that decision with the Academy Trust auditors and state that in your Academy accounts. And if you then go on to continue with that related party transaction, potentially you're going to get a notice to improve and possible ESFA direct intervention. So you do need to be aware there are consequences of not getting prior approval for something that is needed. So a reminder about related parties. The definition is persons or entities with control or significant influence over an Academy Trust. And typically that might be a parent, key management personnel, close family members, as well as the trustees, the members of the trust, or their relatives. And it is all about, the concern about related party transactions, all to do about Academy Trust having absolute transparency about their transactions. Is there clear, decision making that is, open, at arm's length, it's not contentious, and so on. So it is about that transparency aspect and making sure that all decisions at Academy Trusts are done with that in mind. And for audit purposes, that is why we ask all trustees and key management personnel to complete a related party questionnaire. And that questionnaire does include trustees and key management personnel saying who in their household owns a company. because we need to check, whether that company, for example, has had transactions with the Academy Trust. There is a special exemption to do with related party transactions, again to do with church, schools and faith organisations, because effectively the ESFA have said services delivered by faith organisations and dioceses to the Academy Trust are deemed to meet the at-cost requirement. So they need to be declared but don't require prior approval. But anything else, that's a particular area, but any other transaction with the diocese does need prior approval. So I think the main point is, do your staff, your finance team, those who have got budget authority within a trust, the trustees themselves, do they understand the requirements and the rules? So it's just to make sure that there are reminders about related party transactions, that is, there are, should be updated discussions about it. It's a good time of year, either at the end of term or probably the beginning of September, when the questionnaires are handed out, just to have a short session with trustees and key management personnel to remind them of the rules and why they are important. So a quick reminder about what a related party transaction is. It can be a resource or a service with a related party, and regardless of the value, because the value is important when it comes into what the rules are. So if the transaction is going to be worth more than 2,500, then it's got to be at no more than cost. So you need a way of confirming that the quotation that you've got, the tender that's been provided, it is at cost, not at including a profit margin. If you've got, if you're going to enter into a related party transaction, then you've got to declare that intention. I'd be aware that it's a related party before you confirm and enter into that agreement with them. Sign a purchase order, sign a contract, and so on. And you need to seek prior approval when the transaction, the single transaction, is over 20,000, or cumulatively in any 1 year to the same related party, the transaction is over 20,000. So again, just awareness of those rules. And we just reminded you on the slide about the process for requesting related party transaction permission, which I'm sure you're all aware of. But it is about having all the information to hand before you start the request, because you can't sort of enter some of the information and come out because it won't have saved it. So that's just a niggly little thing, just to make sure that you have all the data to hand before you start the process. So the very last slide, which wasn't on my introduction bit, was I just thought a quick reminder about severance payments, because there is a new requirement this year. I just thought we might get a few questions about this, so I just thought I'll just put this in, is that there is a change in the accounts this year, in that you do need to disclose the value of all severance payments made in a period. So it's contractual, as well as statutory and any special severance payments made outside statutory and contractual requirements. So you have to disclose the number of payments that you've made, including contractual severance payments, within bands of 25,000. So, in the model accounts, it shows an example of 5 severance payments being made that in total come to somewhere between 0 and 25,000. You only have to disclose individual values without names of special severance payments. So this is where you've done something outside contractual statutory requirements. So this is where you might get settlement agreements or something. And you do need prior ESFA approval for any payments, special severance payments, so outside contractual requirements of 50,000 or more, or where the total exit package is 100k or more, or the employee earns more than 150,000. So just for you to be aware of those particular requirements this year, and the need now to disclose the number of total severance payments made within a period. and I think we've got one question that might be relevant to that.
Yeah, so someone's asking, if an employee earns or is going to earn over 150,000 in an academic year, do they need to get prior approval from the ESFA?
I will probably need to check that. I'm not aware, off the top of my head, I'm not aware that you do, but we will follow that up and post that information out, that answer out, and give you the link of where the requirement is, if there is that requirement. I'm sorry, I can't quite remember that off the top of my head. So I think we're now at the stage where if anybody does have any other question that they'd like to us to answer, please do put that through the chat line, but if not, then do send us any of your thoughts or queries or questions, you know, by the normal route.
Yes, Bianca, we've just had a general question on tendering, where an Academy Trust has gone out to tender for a large capital project, of which they followed their financial procedures manual for. They're then looking as part of the work to do an additional area. Would they need to go out to tender for that additional area again?
So what they need to do is look at their financial procedures first of all to see does it fall within that criteria, or whether it's something that the trustees need to be aware of. Is part, it means that they've, if it was part in addition to the original tender, is do they need to record their decision about why they wouldn't go out for tender again and go through the whole process again because of that additional thing that they want to do and the cost of that. Because it is about always, everything you do in a trust is about showing that you've thought about it logically, reasonably, and you've got value for money and you're open about things. So I think it is about recording. If you're not going to go out for tender again, that's fine, you know, as long as the trustees have all recorded their discussion about why they think they're still getting value for money by not going out to tender again for that additional area of work that they want doing.
Okay. Going back to the reserves section, so can the trustees' view of reserves be a percentage of GAG income, or does it have to be a specific amount?
You can say it's going to be a percentage. You know, I think you can do that because it's to get some idea of the amount, because you know somebody might have reserves of 500,000 and that might be perfectly okay, or might not be. So you need some measure, you know, some ability to relate what you're saying in the policy to the amount that you've got to make a judgment on whether you've got enough and you're fine because it fits in with your policy, or you're way off the mark. So I think you can say a percentage because that's quite visible in the accounts.
And then looking at the severance payments, does the disclosure include employer pension contributions? No,
it is just the gross figure.
Okay, and no further questions.
Okay, thank you all very much for joining us this morning. Our next session next week is going to be on the Academy Trust Handbook, which is due to be published this month. So I am keeping my fingers crossed that it's not going to be published on the morning of our webinar, otherwise we'll have our work cut out, but we'll see how we go. So thank you very much indeed for listening to us this morning.